Greg, at the beginning of the show, I don't know if you caught it, no worries if you didn't, Jim O'Neill, formerly at Goldman Sachs, made a point, basically said this, I'll summarize. It was very easy to look very smart in the stock market the last number of years because central banks threw so much money at everything, everything went up. I suspect you're here to say, with the Fed about to raise rates potentially a lot, it is going to be a lot harder to make money in this equity market.
Well, first, Brian, thanks for having me back. I did see this segment, and not only was it easy to make money in stocks the last 10 years, but in bonds, everything made money in a decreasing interest rate environment. And we're in a new paradigm, and I think investors need to really embrace a new reality of, number one, much more volatility in markets, like we've seen the last few weeks, and muted returns, going back to a normal return environment where stocks earn 6-7%, bonds do 3 or 4, private investments are 4 or 5.
So what do we do if one of our viewers has, 90% of their money in the QQQ or some sort of FANG index? And by the way, some of them probably have, and they've looked very smart, made a lot of money. Congrats to them. If you are overweight high growth tech, what should we do now?
Yeah. So 2 really important things to do in that circumstance, Brian. Number one, reassess your planning assumptions. Again, if you're about to retire, saving for retirement, are retired, those 8 or 9% returns in balanced accounts, we should be focusing more like at a 4 or 5% return with the same level of risk and basing your spending and saving assumptions on those types of numbers. Secondly, embrace the volatility, Brian. When we have market peaks like we did in early January, that's the time to raise cash for taxes, tuition, spending money, do your charitable giving, give to family members when markets are high. When markets are low, like they are today, we've had a dip. Now's the time to add cash to equities. Now's the time to do those IRA to Roth conversions. Now's the time to tax loss harvest. And then thirdly, to your point on the equity allocation, this is not an environment anymore to put money in a target date fund and set it and forget it. We see too many investors still overweight large cap growth. And I think the trend we've seen over the last 6 to 8 weeks of dividend growth companies outperforming pure growth companies, that trend we believe has legs. And secondly, Brian, these emerging markets, which have underperformed locally, US, we believe those are staged to outperform as well.